From now on, every time someone talks to you about fixed income, variable income, ETFs, index funds, the Federal Reserve, or interest rates, you'll know exactly what they mean. And trust me, that knowledge can help you make better decisions with your money and improve your personal finances. Because beyond just understanding the terms, you'll also learn how to spot the best times to invest. Let's start with the basics. What are central banks? Central banks are institutions in charge of managing a country's monetary policy. In the U.S., that role belongs to the Federal Reserve. They control the printing and distribution of money, and they set the country's official interest rate. Basically, they set the rules of the economic game. Why should you care? Because the interest rates set by the Fed directly affect how much you pay on a loan, your mortgage payments, how much your savings account earns, and more. In 2020, during the pandemic, the Fed lowered interest rates to nearly 0% to encourage spending. That meant many people were able to take out very low-interest loans to buy homes, cars, or even invest in the stock market. Sounds great, until the rates go back up. When that happens, those same loans get more expensive. If you have a variable rate mortgage, your monthly payments could go up by hundreds of dollars. That's why it's so important to pay attention to the Fed's decisions. They directly impact your wallet. What is inflation? Inflation means that the same amount of money buys you less over time. In other words, your purchasing power drops. In 2021, you could buy a dozen eggs for $1.50. A year later, that same carton cost nearly $4. That's not because eggs became more valuable, it's because the dollar lost value. Inflation is often caused by too much money in circulation. When money is printed without real backing, like production or reserves, prices go up. Extreme examples include Venezuela or past Zimbabwe. And what about devaluation? It's different. While inflation affects internal prices, devaluation happens when a currency loses value compared to another. For example, if the dollar weakens against the euro, you'll need more dollars to buy the same things in Europe. That's especially important if you travel or import goods. Now let's talk about investing. There are two main types, fixed income and variable income. Fixed income means you know in advance how much you'll earn. It's safer but offers lower returns. U.S. Treasury bonds, you lend money to the federal government and receive a fixed interest rate, usually 2% to 5% annually. Certificates of deposit, CDs, from banks like Chase, Wells Fargo, or Bank of America, you lock your money in for a set period and earn a guaranteed return. Variable income, on the other hand, can earn you more or cause losses. It's unpredictable. Stocks from companies like Apple, Amazon, or Google. ETFs like SPY, which tracks the S&P 500 index. The S&P 500 includes the 500 largest companies in the U.S. When you invest in it, you're automatically diversifying. If one company loses value, others may make up for it. That's why index funds and ETFs are so popular. They offer diversification, are easy to understand, and are accessible through platforms like Fidelity, Vanguard, or Robinhood. Key difference between ETFs and index funds. ETFs trade like stocks during the day. They have lower fees and provide immediate liquidity. Index funds are updated at the end of the day and usually managed by humans. They can offer tax benefits if you reinvest your returns. Now, let's talk about the stock market. Imagine you're in a stadium. Companies are the players, CEOs are the coaches, and you're the fan betting on the team you believe in. When you buy shares, you're betting on that company's future. If it performs well, you win. If not, you lose. You can also invest in commodities, like gold, silver, or oil. Currencies, forex, like the dollar versus the euro or Japanese yen. Investing versus trading. Investing is long-term, you buy and hold for years. Trading is short-term, you buy and sell quickly. It requires more skill, technical analysis, and emotional control. For example, day trading involves opening and closing positions within the same day. What's a correction and what's a bear market? These two terms get thrown around a lot, but they're not the same. Correction. A market correction happens when a stock or index, like the S&P 500, drops between 10% and 20% from a recent high. It's totally normal. Corrections happen about once a year and usually last a few weeks or months. Think of it as the market taking a breather. For example, if the S&P 500 rises to 4,800 points and then drops to 4,300, that's a 10.4% correction, not a crisis. Bear market. A bear market is more serious. It's a drop of more than 20% that lasts for months or even years. It's often tied to recessions, fear, and a lack of investor confidence. In 2008, the market dropped over 50% and took years to recover. In 2020, during the pandemic, the market plunged over 30% in just a few weeks, but that time, the recovery was fast. A correction can be a good opportunity to buy if you're thinking long-term. But a bear market requires more caution, because it may signal deeper economic issues. Understand what the Federal Reserve does and why it affects your money. Know the difference between inflation and devaluation. Invest smart. Use fixed income for safety, variable income for growth. Use tools like ETFs or index funds to diversify. Decide whether you're a long-term investor or a short-term trader. And most importantly, start today. You don't need thousands of dollars. You can begin with just $50 or $100 right from your phone. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell. See you soon, and remember, make your money work for you.